All right. Well, welcome everybody to the Canary Digital Fund Macro Outlook for 2025. Just a little bit about what we're about here at Canary. We actually started Canary Capital to run active strategies in crypto. Most of our backgrounds are in traditional finance and crypto finance. I've been running funds for the greater portion of over 15 years, both in bonds and in other esoteric assets, and then moved into crypto in 2016. So and Josh here has been running crypto strategies for for over 10 years as well. We came together and launched a fund a couple of years ago, and we've been very excited about it. We've been running a fund that essentially marries crypto with bonds, utilizing bond strategies to de-risk some of the volatility and drawdowns of the crypto markets while still being very active in the crypto markets.
And for today's discussion, Stephen will be discussing the macro portion, focusing on all the good stuff, CPI, interest rates, jobs, yield curve, dollar weakness, and liquidity. And then I'll be focusing more on the digital asset side, comparing the cycles and technical analysis, of course, along with some Ethereum versus Solana commentary at the end there.
All right. So, really what we look at when we're running our strategies are macroeconomics and how they drive risk markets. Crypto is indeed a risk market that we're very active in. And then we marry the macro analysis with technical analysis as we trade around our established positions. So really on the macro side, given that I'm a bond guy, been a bond trader, bond manager for most of my career, I can't help but look at the bond markets and what drives them. One of the things that really drives the bond market is the Fed. And of course, what drives the Fed? CPI and employment data, as well as several other points of data. So first of all, looking at both CPI and core CPI and what our expectations are. I'm going to be the first to say that the Fed has always tried to manage a rate of 2% plus, and I say 2% plus because they don't want inflation to be below 2%. There's the constant inflation rate that's essentially a tax on everyone that the Fed likes to keep up. They use the argument that they're trying to keep prices stable. And as long as prices go up, they're stable. Technology actually causes prices to come down. If you remember, flat screen TVs, and even in today's dollar terms, were more expensive than what 10 years ago than what they are today. So as technology progresses and we create better and more efficient ways to build things, prices naturally come down in that environment. Now the Fed wants to keep prices up, so they focus on CPI. So really, what they're trying to do is focus on that 2% plus CPI without going too high, without going too low. And in the last 5 years, CPI has been too high. So now they're really focused on driving it down. What's been driving markets really, higher interest rates have been causing mortgage rates to go up, borrowing rates to go up, which has caused a suck in available capital to actually make investments. And as CPI is high, the Fed's been trying to manage it by increasing interest rates, but also by unwinding the balance sheet, which grew pretty large in two periods of time. First in the financial crisis, 2009, and then second during COVID. So right now, CPI is still above the 2% target. We expect it to be that way for a very long time. It's going to be very difficult for the Fed to actually bring that rate down to 2%. Now, if you've been paying attention, you'll notice that in the past, we've had inflation north of 10% at sometimes. One year it was 8%. So even though they're trying to target 2%, they're not making up for the higher inflation in those higher CPI yields. So what really needs to happen is inflation needs to go below 2%. to offset that. But the Fed's really targeting 2%. So again, as far as CPI goes, we really don't have an expectation that it'll go lower. And actually, during Trump's term, it'll probably go higher due to promised um, tariffs. So the U.S. Fed has been cutting rates. That is starting to pause a little. We've had several rate cuts last year, which continue to drive markets higher as the Fed began to worry about unemployment. So the Fed now has a dual mandate of not only inflation, but also employment. And employment was trending higher, or sorry, unemployment was trending higher, even though it's below uh, the full employment rate. So the optimal employment rate is actually just above 5%. But we're below that. And as it was trending higher, the Fed decided to cut rates, despite the fact that inflation was still high. Now that we've gotten to a point where that rate of unemployment rising has stabilized at around 4%, as well as slightly higher inflation than they want, we believe that the Fed is probably going to only going to implement two more rate cuts of 25 basis points in 2025. The markets, of course, are looking at the first one in June. I actually believe it'll be a little sooner than that. We'll probably get something in March. Uh, Likely no rate cut in January, but we expect the Trump administration to put some pressure. So either March, maybe even out to May, and then the next one coming likely in September. So the big question is with these, with unemployment creeping up, with the possibility that inflation continues to rise, are we going to have a hard or a soft landing? Well, the Fed has actually done a pretty good job of ensuring a soft landing. There's been increased economic activity since the election of President Trump, and now that he's been sworn in and inaugurated this week, we do expect better economic activity, higher GDP, but also higher inflation. And we don't know where unemployment's going to go. And I say that honestly because usually we've got a pretty good pulse on the market, but there's a lot of promised cuts in government, which would add to unemployment. But there's also a lot of promised investment into the economy in areas like AI that will likely create jobs. And there's still a debate over HB1 its status and where that's going to go. I don't believe that's going to go away, but we're currently in a wait and see mode as far as where unemployment will go. My personal preference is that the government cuts as many jobs as possible that aren't needed, and we get higher unemployment for a period of time. It's actually the best thing for our economy. So hard or soft landing, we don't know yet, but we will keep our pulse on the market and see what happens. The next thing we want to talk about is dollar weakness. So, of course, after the inauguration, what happens? The U.S. is or the Trump administration is beginning to uh, cut programs, cut government spending, but at the same time, there's other activities that would likely cause the dollar to be a little bit more weak. Borrowing costs to fund new programs, even though some programs are being cut, as well as I mentioned before, further investment into the U.S. So we have had some dollar weakness, and in the last administration, we'll wait and see, but we do expect further dollar weakness in this administration as well. And then, of course, liquidity is a really big driver of Bitcoin. And then I'll hand it over to Josh. But global liquidity is actually higher, meaning more money is being printed around the world. There are either recessions or almost recessions in several economies, including China, Germany, which are very large economies, as well as a lot of the EU. So, and then of course, the UK is experiencing extremely high inflation with a lot of economic slowdown at the same time. So, we do expect more liquidity to come into the markets, meaning, more money is being printed, which is good for Bitcoin.
Absolutely. And another way to think about this is look, if you think dollar US dollar positioning or dollar is positioned to do well in 25, then it's unlikely that Bitcoin is going to do as well in 25. But if you are on board of this narrative of weaker dollar, stronger liquidity, then Bitcoin is poised to do well in 2025. And of course, the question is always, what's the narrative? What's the next thing? What's the next thing? What's the next thing? Coming into 24, we had the halving, we had the ETFs were just getting approved. Then the ETFs came online. So now the next thing is going to be, what's the next narrative? And well, the emerging narrative at the moment tends to be this strategic Bitcoin reserve idea, whether that's at the federal level in the United States or the state level. We're seeing lots of interest around that. Whether or not any of those things come to pass, we'll see. But the market wants something to latch onto. So that is a growing narrative at the moment. Absolutely. We also have, of course, publicly traded equities that are continuing every day to add Bitcoin to their treasury. MicroStrategy being the most prominent amongst them, as well as several Bitcoin miners. This excites me for the bear market because it's going to be easy to look at and see, how much Bitcoin are these companies holding, who's losing their religion, who is selling into weakness. We saw this with ETH in 2018, post ICO boom. I expect the same for whenever the bear market happens to be in BTC, whether that's 2026 or later this year. We're seeing a lot of companies add Bitcoin to their balance sheet to try to prop their own stock price up. I see new headlines every day. It's also worth mentioning all the other countries around the world, all the other growing micro strategies like Semler and Metaplanet. And there's also a lot of altcoin foundations and treasuries that are actually holding a fair amount of BTC still, allegedly, depending on whether or not we can actually track that. Tezos Foundation is one, Block One, which was the EOS backer, is one, and of course Tether is also buying a lot of BTC. And it's also worth mentioning that if we do see a SAB 121 repeal, that would allow for banks to custody digital assets more easily, and that should allow for more access, more regulatory clarity, and just more involvement outside of crypto natives for digital assets. Of course, everybody wants to know, where are we in the cycle? There's this obsession, whether you're crypto native or not, because of probably the volatility and because of the numbers that Bitcoin tends to put up year over year, that nobody wants to be on the wrong side of the cycle. So we can dice this and slice this a few ways. We can look at where are we relative to previous elections? Where are we relative to even Trump's term? What is this most similar to? What do we expect to see here? Historically, what we've seen, even though we don't have 100 years of data, what we have seen is acceleration of price post presidential election. This election so far hasn't been any different. Obviously, we all know what happened on November 5th thereafter. This cycle is most similarly analogous to the 2016 cycle, which was, of course, also uh, Trump's term. We can also look at this from a cycle low perspective. So the cycle low currently would be November 2022, just after FTX blew up in spectacular fashion. So from there to present, we can look at that index value on a relative basis and compare that to previous cycles. Does this look like the beginning of Bitcoin's history? No. Does this look like the next cycle? No. It looks most like the previous two cycles, which to me is encouraging because it says we have a little bit more time here relative to the cycle low. Again, everybody's just, there's this obsession with where are we in the cycle? Where are we in the cycle? No one wants to hold the drawdown. No one wants to hold through the bear market. I get it. But this adds to confidence along with the post-presidential comparison that yes, we still have a little bit more time left. And if this is anything like the 2015 to 2018 cycle, we still have the entirety of 2025 potentially for price appreciation. If we compare this to last cycle, basically at this point in time, this was the top that got put in, and we did not exceed that in a realistic way for the entirety of that cycle. As far as the technicals that we're watching closely here, it's important to have just price models and a theoretical ceiling, whatever that is. It's important to look at from a technical perspective what has worked in the past on backtesting, what could work in the future. This is again theoretical if we're thinking about adding risk here, taking risk off, if we're thinking about risk versus reward, if we're thinking about ecosystem as a whole, what might happen at these price levels. I get more bearish the closer we get to 300K just because that, if we get there, that's a big number. But if we get anywhere close to that level, the risk reward diminishes significantly. So we can look at the power law corridor, which is a Bitcoin Maxi popular price model. The two-year moving average multiplier, also fairly popular, giving us a decent ceiling left in the tank here. Another metric we can look at is marrying market cap versus on-chain activity. We can look at when coins have moved last on-chain. And essentially what MVRV is showing is unrealized profits that are sitting on-chain. So effectively, when unrealized profits spike on-chain in a big way, that has marked a cyclical top in price. So just in this bottom panel here, you can see we're not close to that 6+ level on MVRV just yet. And then lastly, to me, the other most important chart this year is just the vanilla cup and handle chart pattern that is in the process of playing out. And once again, gives us this like 180 to 300 massive level to watch for going forward as a ceiling for the cycle. We, of course, have had a great year for BTC on the ETF front. Cumulative inflows net were plus 36 billion on all the lists. My favorite part is listening to these macro guys outside of crypto. They cannot stop talking about BTC, and I just love it. Everybody asks them, what is your opinion here? Most of the time they say it's a scam or they hate us or, don't own this stuff, whatever. That's fine. That gives me some encouragement. But clearly, we had some significant inflows last year. Even on a weekly basis, we're seeing continuous inflows for BTC between 1 and 2 billion. So if we continue to see that, that's going to be a headline to watch for. Do we see an acceleration? Do we see a continuation of that for BTC? Now, ETH is a completely different story. ETH launched in July on the ETF front and really has had trouble getting off the starting line. It's hard. It's a harder sell. It's harder to explain ETH to TradFi folks. It's harder to understand what the use case is there outside of BTC. And there's no yield on the staking front. It's kind of the worst of all worlds for a lot of people trying to get into that product. So it makes sense to me that ETH has underperformed on the flows relative to BTC. If ETH does well this year, this is going to be another headline to watch. Does ETH start to pick up on the flows front? It seems fairly obvious that if retail and institutions both are not interested in ETH and they're interested in something else, it's fair to expect ETH to underperform the rest of the market. And we talk a lot internally about relative performance and relative strength when deciding on positions and position sizing. Another kind of obscure metric we look at for cyclical comparisons, again, we don't have 200 years of data. We have what we have. But if we look at 2018 and if we look at 2022, and we compare the market cap of Bitcoin to the market cap of everything else, all the nonsense we hear about, if we compare those side by side, what has happened historically is when the non-Bitcoin market cap exceeds the Bitcoin market cap, that is a major warning sign that we're getting close to the top. If we want to measure froth, this is one way to do it. We haven't seen that to even start yet. We are still seeing significant Bitcoin strength. Obviously, the ETFs playing a big role there, accessibility to institutional flows and capital playing a big role there. And that may shift in 25 with other ETFs potentially coming online down the pipe. But just objectively looking at this tells me two things. One, we're not close to the top if it's similar at all to previous cycles, and there's still a lot that could flow via wealth effect from Bitcoin into alts potentially. So it's definitely something else we're tracking. And now if we want to talk about Ethereum, Ethereum versus Solana and Bitcoin, um, the bottom line for Ethereum is it's expensive relative to other options. There's ETH, the main base chain, that's the layer one, and then there are L2s, Arbitrum, Optimism. For those on the call who have transacted on chain, you'll know what I'm talking about here when I say the preference for most people is Arbitrum. The preference is an L2. It's faster, it's cheaper. Okay, great. Why is that bad for Ethereum? Well, that means most of the value accrual tends to happen on those chains that have separate tokens to ETH. As you can see here in the transactions per day, Arbitrum in the red line there is seeing significant transactions per day. ETH, albeit kind of topped out for the past few years, we're not seeing an uptick in activity there. So effectively, ETH is competing with its own L2s for value outside of everything else, outside of Solana, outside of Bitcoin. And that's been a real problem. They're trying to dial this in. They're trying to figure out, okay, we have this burning mechanism for tokens on chain. If the fees are high enough, if the fees are too high, then people go elsewhere. And it's this yin and yang that they're trying to get right that they just haven't been able to dial in. So value's gone elsewhere. Value's gone to Solana. Value's gone to other competing L1s. In September 2024, sorry, that should say 23, they switched from proof of work to proof of stake. They promised, rainbows and butterflies and massive burns on chain that would effectively lower the circulating supply. All that started to happen, and then the layer two stuff took off in April. So again, you have fees that are non-competitive. You've got a token supply problem, and people just prefer to use anything else. It's just the cold truth. Now, all that being said, on the technical side of the equation, on the technical analysis side, once ETH gets above 4K and can hold above 4K, things look a lot better, things get a lot better. I guarantee you narratives will start to emerge. Oh, ETH has staking in the ETFs or whatever, blobs are figured out or transactions. It doesn't matter what the narrative is, a narrative will emerge. And ETH has the technical opportunity to do well this year. For most of last year, it was actually flat or down. So it didn't really do well and hold that strength until the back half of the year. But ETH certainly has the opportunity to do well in 2025 here, despite all the negatives. It's so bad on a relative basis, even in BTC land on a relative basis, that it's just going to be obvious when ETH starts to do better for whatever reason. And if we compare just the utility, what are people doing on chain, Solana versus Ethereum? Even if we were to add those layer two active user wallets to this graph, it wouldn't come close to what's happening on Solana. This graph, by the way, was created before this weekend, which was the release of Trump Coin on Solana, which saw a massive uptick in active users. So no matter how you try to look at this, Solana is winning the hearts and minds of retail, Main Street, without casting a value judgment on what they're doing on that chain. We can say it's a casino, it's regulatory arbitrage. That's fine. But clearly people are using the chain. They're not just sitting on Solana staking it like they are effectively on Ethereum. They're actually using the chain and there's utility there and it's measurable. You can see it based on the wallet activity there. Looking at Solana from a technical lens, it's plus 1000% since mid 2023 still. So the question I always have with these non-BTC coins is they've done really well. What more can we realistically expect here? We have a lot of inflation on Solana. We have a lot of unlock activity coming in the next couple months, vesting of coins, effectively a lot of that sourced to FTX or FTX creditors. that will most certainly be sold or has been sold already. How much of that is priced in? So there's a lot of things that need to get figured out here for Solana. But again, if Solana wins the hearts and minds of retail, if it wins the eventual potential ETF battle, then where is ETH in that equation? ETH is uh, maybe potentially a relative value play later on this in the cycle, but uh, ETH is definitely experiencing some significant competition here that it makes sense that we're seeing the performance that we're seeing. So outside of that, we of course trade many things. If you have any questions further, feel free to contact us, our head of sales, Kathleen, myself, Josh at Canary Capital as well. And I think we'll open up here to questions in the last few minutes if we have any.
Yeah,
Stephen,
so first of all, there was a question that came in asking us what our price targets are. We do have some internal price targets on Bitcoin, ETH, and Solana, which was the question. First of all, our target for Bitcoin for 2025, we expect it to hit somewhere between 160 and 250. I think our general consensus is about 180. But it could be a little bit less. It could be a lot more depending on some executive actions and other laws that are potentially passed this year. But those are unknowns that we can't really price in until they're known. So 180 ETH, we're probably have a target a little bit lower as far as an increase goes. So we're probably in the realm of 4 to 5 thousand. Solano could potentially double if there's a ETF this year, which we believe there very well could be. Well, thank you very much for joining us on our first of the year call. I hope you all enjoyed it. We'll be doing this once a month, so we'd love to have you back, and we'd love some more interaction. Wait, there is one more question.
I can't see the questions, so I'm not sure where they're coming from here.
I typed it. Oh, here's one. Any news on a Litecoin ETF? Now that's something that we really can't answer that publicly right now. We are working very diligently on trying to work with regulators to get a Litecoin ETF launched. We filed a S1 back in October. Oddly enough, right around the 10-year anniversary of Litecoin. And we also, have filed a 19B4, but that's really all we can say at the moment. But we do have high hopes for a Litecoin ETF. As far as demand goes, we actually do see a lot of demand. Litecoin is one of those coins that, it was in the top five for many, many years. It was listed as one of the three tokens on CNBC forever. So it's got a lot of brand recognition among retail investors. Gary Gensler has mentioned it several times as the list of coins that are not securities, being Bitcoin, Ethereum, and Litecoin. So yeah, we do believe that there will be a lot of demand here, and we're very excited about that prospect. And then as far as AI and other potential investments, we actually believe that AI is going to be a big theme for 2025. It's going to get a lot of government investment. We're seeing a lot of Bitcoin mining companies as they're building new facilities, building it out so that when the machines start getting old in 3 to 5 years, which is typical life is about 3 years for a miner, that they could switch them out for AI compute. So that's a really interesting prospect in the area of AI. And then yeah, we've got a couple more questions, but none that we can chat about right now. But of course, we're spending most of our time, actively managing our fund while also trying to push through a few ETFs, which we're very positive and very constructive on. So thank you so much. Any other final thoughts, Josh?
That is all I have at this time. Thanks everybody for joining us.
Thank you.